The Dow Jones could be flat for the next 10 years. That's what Stanley Druckenmiller, the legendary investor, just said. He is generally bearish on the market, so that's something to consider, but he's a legendary investor and has essentially nailed this thing the whole time. He was just in a conference, and this aired on October 20th, 2022, and essentially said that because of all the stimulus that has happened in the prior 30 years and the situation we have now with inflation and big government, and then there's everything going on with Ukraine, there's possibilities of issues with China, all of this stuff, all of these issues, he sees a scenario where the stock market could be neutral or lower for the next 10 years. So I'm going to share my thoughts on that. Also, two companies in the portfolio, Tesla and Taiwan Semi, have reported earnings over the last week. We have Meta and Shopify that report earnings next week, so I'll cover those. And if you're new here, I am Austin. I'm building a $1 million portfolio right here transparently on YouTube. We're at $103,000, almost $103,200. We are up about $3,000 on the week. Overall, we have put in $119,000. We started on February 15th, 2022. So I've been investing heavily in this downturn, and I was early, right? I was early on it, but this is a long-term portfolio, and I would actually prefer that the market is flat to down while I'm adding money to it, especially early on, because I think that over time, and we see here, I'm going to go through some examples of why I think a flat to down market could be good for long-term investors if we can stay focused, because there have been some incredible stocks and incredible gains made for investors that are able to hold or add over time. And some of these great stocks, we just looked at Tesla, Nvidia, and Costco, that had long periods of time that were flat to down and then exploded eventually. I'm going to talk about why that happens and why I think that, Druckenmiller might be right, but I don't know what the market's going to do next. All I can control is my emotions and my strategy, my personal finances, and living below our means, putting ourselves in a position to be able to invest for the long term. That's the way I'm going to handle this type of situation, because I don't have the data and the team and all the analysts that Stanley Druckenmiller has to know when to go in the market, when to go out of the market. That's not my game. And that's not a lot of people's game, right? So my approach, even if he is right and we enter some dark recessionary period, which I'm not sure if we will or not, we probably will most definitely be in a recession. He thinks 2023 for sure. My approach is to just have a process that I can continue adding to the market regularly, not use margin. I'm not going out and buying big expensive things or going on crazy trips right now. I think that's something that everyday people like you and me could be doing right now, is just thinking about our finances and just being, stricter with ourselves, and because of all the unknowns out there. And this is a practice that's good to do anyways, right? And so for me, that means it sounds simple, right? But like things as simple as having coffee at home instead of buying a $6 coffee at Starbucks, which, yes, doing that one time, not going to make a difference. But the problem is when people get in a habit of that, and I've caught myself doing it before, it's not just one day you go, it's 4 or 5 times a week. And then all of a sudden you're talking about $100, $150 on one thing per month, potentially. $150 on, Starbucks or food breakfast per month. Well, if you're doing that for breakfast, you're probably doing that in other areas too, right? So for me, that's my approach to this whole situation. Manage my personal finances, have it so I can be investing regularly, and take advantage of a flat market over the next 10 years if that happens, worst case scenario, because I'm not investing with money that I need in the next, I talk about this all the time, in the next 3 years or 4 years or even 5 years. And so the further we extend our time horizon, the more likely it is that the market will recover and will do better and will pay off, right? Even if there is a drop in the next year or two, if we're buying that whole time, and then 5, 6 years from now, we might need some of this money that's invested, well, the market's going to go up and down, right? And if we're constantly buying and buying at high levels and lower levels, then we'll have money there to take out. At least that's my approach. I would have money there to take out if I needed it 6 years from now. Or I have savings built up that I can pull from if the market's not doing it. That's why this whole thing is a balance for real people investing real money, like of my own money, like I am. Not, it's different for professional investors, right? Let's talk about earnings. Let's talk about Tesla. And this is Morningstar's analysis, right? So I pay for their premium service. This is not an advertisement, but they do great coverage. And so if you like this stuff, if you want, reliable coverage from a team of analysts that is, relatively affordable, then a service like this might help you be able to cover more stocks and cover the stocks that you own. So you're not just listening to random people like me on YouTube or other people on YouTube. You at least know you're getting analysis from people that actually know what they're talking about. And my goal is to just share this and open up the world of investing and share what I'm doing to other people, right? So anyways, they maintained a $250 fair value estimate as Tesla's Q3 shows sequential margin improvement and shares are slightly undervalued. So they have them rated at 3 stars, which just means it's fair valued, right? See all these stories, Tesla's so undervalued, Tesla's so overvalued. I think, and this is actually how I feel about it, I think it's right in between, right? The things that they are doing could be incredibly innovative and they could be a much larger company in the future, but there's a lot of risks, right? So anyways, they have it as a 1-star price. It would be up to $437. That would be extremely overvalued in their opinion, but very undervalued. 5-star would be down to $125. They give them a narrow economic moat, which I actually think it deserves a better rating than that because there's not a lot of companies that can do all of the things that Tesla can do with everything they have, from their charging network to the data that they have to these different lines of business and the R&D and the production facilities that they have. That gives them more than a narrow moat, I would argue. They give them a capital allocation rating of exemplary. So they said, we'll just cover a few things. They saw a few surprises in the detailed results. The company reported record deliveries early in the month, and the vehicle volume growth was present in the company's financial results as it generated record revenue despite the continued ramp up of 2 new factories, one in Austin and one in Berlin, Germany. Company-wide operating margin improved sequentially versus the second quarter. This is in line with our view that factories will become more profitable each quarter as production increases. I agree with that, and that just makes sense, right? A factory is going to be more profitable as production increases. Despite the signs of improvement, in line with the strong long-term outlook, shares are down 5% after hours. With the outlook intact, they view Tesla as slightly undervalued, with the stock trading a little more than 15% below the fair value estimate, but in 3-star territory. We recommend investors wait for a larger margin of safety before considering an entry point. There you go. So that's Tesla. There was no shockers there. I'm happy with the results. Thesis is intact, which is what I want. If there's nothing broken about what they reported, right? That's the only thing that would make me consider selling. Taiwan Semi. So they actually have Taiwan Semi rated as 5 stars and very undervalued right now, right? So I've talked about it. I've made a video about it. I recently added Taiwan Semi to the portfolio because I felt the same thing. They say it's significantly undervalued at a 52% discount. They say the fair value is 133. The last close is down to 63 with a wide economic moat and exemplary capital allocation. They cut the fair value estimate for Taiwan Semi to US 133 per share as they bake in more conservative assumptions on high performance computing demand in 2023, 2024, recession possibly coming. They anticipate 23 demand to be affected by sluggish PC demand and rebalancing of enterprise computing operations in light of fresh US restrictions on doing business in Chinese customers. That's another big thing. Nonetheless, they believe it does not change the large addressable market, and they still view TSMC shares as grossly undervalued. Their sequential decline in inventory days and management reducing capital expenditure by 10%. So look, getting smarter about costs. They foresee lower inventory dollars and cautious 23 capital expenditure budget as a sign of the stock bottoming. Going to get to my portfolio in just a minute, the full company review, but also want to talk about, we've got Meta coming up, reporting earnings on 10/26, Shopify reporting earnings on 10/27. I'll cover both of those, as well as, what firms like Morningstar say. So you're not just listening to me, but you're seeing, other opinions as well. And then here's the portfolio, right? So again, in my thoughts are, I own companies that are growth companies right now. They are mostly in enterprise software. I'm confident that overall, these companies will continue to grow. They have high margin. They have recurring revenue. They serve a valuable purpose, the enterprise software companies that I own, to their customers. They are not the same, in my opinion, as the 99.com era companies that were just internet companies that had no revenue, no value, and everything was valued just on eyeballs on a website. Sure, these stocks got way overvalued in 2021 and previous, but they are very real businesses, and we can see things like net dollar retention rate, where current customers are spending more every year. Metrics like that, high gross margin, recurring revenue, offering new product lines, government spending with them. Those are the kind of indicators that show these are real businesses. We want to buy them at the right prices, which is mistakes I've made in the past. Everybody's made those mistakes. But that doesn't mean that they are sells now, that the stock price is so far down. I think they're actually much more fairly valued. Their businesses continue to be strong. They continue to outperform and beat expectations for the most part. And I'm confident that they'll do well over the long term. And I'm about to share 3 examples. Again, Tesla, Nvidia, and Costco that, yeah, sure, their stocks got overvalued for a while. The stock price was stagnant, but those who held and added and watched the execution and they maintained their execution, investors were rewarded. And that's what I think is going to happen with the companies I own. But that's just my opinion. So anyways, here you go. From largest position to smallest: Snowflake, Rocket Lab, CrowdStrike, Datadog, Meta, GitLab, The Trade Desk, Cloudflare, Airbnb, Bill.com, Taiwan Semi, Advance Auto, Tesla, Shopify, Mongo Database, and Mercado Libre. That is my portfolio. Let me know what you think of it in the comments. All right, let's talk about this. So, a flat market for the next 10 years. Well, sometimes flat markets can be great, right? If you were a Tesla investor from 2014 to 19, the stock was actually down 3%, right? So we are talking about a 5-year period, 5 years and 3 months where the stock went down, right? But then eventually the company keeps executing, they keep recording more revenue, they keep improving on margins. Eventually things take off, right? And so, I mean, we saw how crazy it got, but even before all the craziness that happened with COVID, if we just go to 2019, then still from 2013 to 19, when the shares were at split adjusted $28 a share, you still made 191% for 19% annualized. That's a fantastic return. And then if we go from, there to today, even after its crazy drop, you're up 2,461%. That is the reward for continuing to buy great companies that are executing well, regardless of the stock price being flat or the overall market being flat and all the fears and everything that goes on. Continuing to focus on owning great companies or just investing regularly over the long term. Another example is Nvidia, right? From 2007 to 2015, you actually lost money. To 2016, 9 years. Over 9 years, you had a negative 1% total return. You bought right before the great financial crisis, and over the next 9 years, you made nothing. Even to today, if we go to today, where the stocks, it's down like 70 or 80% from its highs. If you bought and held over the last 9 years or added regularly, imagine how much better that would be when you're buying shares, more shares down here. You made 1,218% over those 15 years for an average of 19% annually. Amazing returns. Costco. Okay, I talked about 2 crazy growth companies. This is not a growth company. I mean, it actually has been a growth company in the past, but more seen as like just a stable, amazing dividend company. If you owned it from 2004 to 2009, you made a total return of 8%, so 1.8% annualized. But then if we go even right before the great financial crisis, 2007 to 2009, so over those 2 years, you lost 36% on that stock. But then if you had bought right at the peak of 2007 and held to today, you are up 670% for 15% annualized. And you've gotten paid $8,098 in dividends on a $10,000 investment. So you've almost made 100% on just dividends alone. But then when you do the market value plus the dividend, you've made a $10,000 investment. You've made $77,000 on that, so it would currently be worth $87,000 if you started with $10,000. Druckenmiller might be right. The market might be flat to down for the next 10 years. I am investing in a way that I would be okay with that because I'm investing for the long term, and eventually things would get better and catch up if you're invested in the right businesses.